And I'm curious if anyone's ever done that, please put in the comments or whatnot. But 80-20 is basically saying, if I'm going to create a $250,000 note, I'm going to create a $100,000 first, a $150,000 second. I can sell the $100,000 first to whoever and keep the 150 as that. Or if it's 300,000, I can create 250 and a 50 and keep the 50 and keep payments rolling in and get my cash out of the first one. Nick, is that kind of how you guys do it?
Yeah, we actually have lowered. So when I started doing this, it's a moving target. I will never negotiate interest rate with anybody, period. My rate is my rate. And if you don't like it, then don't buy the house. Okay. I'm not going to manage the problem, right? Because I already know what the answer to the question is when I go sell you the note. Okay. Yeah. I already know all things considered. I already know what your yield's going to be. And if rates are going up and inflation's changing and people are changing it, like you said, you know, I just showed you when we started how CD rates were 14%. Now they're not going to go to 14% back in 1982. Not going to get there again, but the higher other things start paying relative to a 10% yield or return, the harder it is for me to compete like for your money, right? As you know, because you have a decision to make because you're an investor, right? You're going to say, I got $100,000. Where's the best place I can invest that $100,000 relative to risk and return? Well, if you can get 12% in a CD in this example versus 10% on a secured mortgage note, like with some borrow, you're probably going to take the CD. So we want to create that gap as much as possible. And the only way I can create that is by controlling the interest rate. So I know when we discount it back to you. So what we started doing is, you know, before, here's a big challenge. Okay. And I don't know, I'm curious to see where you are on this, Dave, is that when we first started doing this, I was writing first liens at 78% or less. Okay. Okay. And now I'm down to 70 to 72 because what's happened is that real estate prices are not increasing like they used to be. They're flattening out or even going down in some places. And so when we do the note, one of the things that determines what you're going to pay is what it is, what's the investment to value, right? Yeah. The ITV, not necessarily the LTV or the loan to value of the borrower, investment to value. So if I'm wrong on my assessment of value and you come in and say, well, I don't think it's worth 200,000. I only think it's worth 190. Well, then you're setting it and I lose that opportunity. So by going to a lower first lien, I get the benefit of having it being in a better position. And I just move that to the second lien, which is my profit or my staying in the deal. Yeah. That's how I minimize getting hammered on the discount when we go to sell. And it's a better deal for the note buyer at the same time.
It's interesting you asked this question. This is a question me and Nathan left about last couple of months. ITV and LTV was something we never looked at because we didn't have it, right? We most of the time, our LTVs in 2010, 11, 12 were upside down. We were underwater and everything, right? So LTV was like, we can get below 100, like, right? Like, so for us to look at now and see, I'm concerned, it's a little interesting, right? The ITV is definitely there, but, you know, because ITV is the fact that whatever's lower is the balance of the loan or the value of the property, which was lower. I'm going to basically go off that number. But so we're looking now, the fact that where do we think the market's going to go? Is this going to go up or down values of properties? If the property values are going to go down, I want to make sure my ITV is lower because of risk level. My LTV is there too, but I'm not concerned too much about that as much as Max is, right? Where my concern is now is I am curious where we're all at. I'm shooting around 65, 70 because I'm not sure, but I'm kind of staying that mark for LTV reasons, right? ITV, it still comes back to what's my return per se, because I can always get rid of the deal. So I'm actually not plugging in too much of the ITV stuff. I am concerned with the LTVs as they come across. But I know the fact that the market's kind of flattening. I don't see a drop. It just stays on markets are extending, whatnot. Nathan, what's your thought about ITVs and LTV?
Yeah, it's a weird one because, like you said, we used to deal with negative LTV all the time. That's all we ever saw. Yeah. So now when we're in a position now.
Do banks write negative LTV loans? I'm just curious.
No.
Okay, I'm just making sure.
Yeah.
That's what
No.
we're
So
earlier.
now we're in a position where the market is dropping and dropping, flattening. We don't know. And that's kind of the thing. So if we've got a 10% down payment that somebody made, okay, so there's 10% equity in there. That's great. And then what? What happens when the property drops by 20% in value and the person stops paying? So it's a bit of a tricky situation for note investors, because like Dave says, usually we'll pay based on the lower of the balance or the property value.
Yeah.
And if we're seeing property values drop, how low are they going to drop? And we're kind of having to do a little bit of guesswork there to see, if we buy it at a percentage of the unpaid balance, but then the value drops below that, are we still protected? That's the major question.
That's a great point, but it's only a problem until it becomes a problem and the borrower defaults, right? So you got to have a lot of things happen, right? It's that 1,000-year flood insurance, right? Same thing. But if we do a good job and follow best business practices from the beginning, we use an RMLO, we service the debt, we take a 1003 application on the borrower, we escrow taxes, insurance, we get a valuation from a BPO or an appraisal on the very beginning, and we stack the file correctly. Everything you're talking about is not nearly as impactful if you didn't do any of it. So, and then you throw in the fact of going to a lower ratio on the property. That's why when we create these notes and we teach it in the Creative Note Maker Academy, it's a win-win-win deal, because the way I look at it, the note creator wins because they're going to get they're going to give up less of a discount and they're going to get more money back. The homeowner, the new homeowner wins because now they have a chance to have a home ownership when other people have told them no. And then the note buyer wins because they're at a lower investment to value, so their risk is down. But here's the thing. They also have the note creator staying in the deal in a junior lien position, which is where all their profit is.
Yeah.
And I agree. And I think that's the right way to do it.
Property and everything. So you have a little bit of the golden handcuff sort of tied to it, and collectively all that, and having a really well stacked property file. Look, we can't predict the future, but I tell you what, I like my chances because I've seen the portfolio over the years. And our default rate on stuff that's been created either in-house or through our under our toolage, it's 1/100th of what the national average is. So look, it doesn't mean that they can't default tomorrow and we can't have COVID 2024 yet. No, of course we don't know that. But
you talk about value of properties. What I did years ago is I created a due diligence portal, allowed me to kind of aggregate everything that I can get online, paid, non-paid, and come together with an idea number. When we bid on an asset, we're bidding on a guesstimate of what the property value is. We don't dive into getting a BPO right away. And to answer the quick question, LTV is loan to value, ITV is an investment to value. So I use my due diligence portal at JKP Holdings, and it allows me to get data numbers, right? And then we have our course, our Building Confidence course. We teach you guys how to figure out with all these values how to calculate these things, right? Yeah. And then we have to also say the fact that it may not still stay performing. We also have to know the fact that it may default, and that means I have foreclosure costs, holding costs, servicing costs in play, that if it defaults, what do you do, right? Because I don't care if the loan's been performing for 10 years. Doesn't mean someone's not going to pass away, someone's lose a job, someone's to get sick, right?
But I think the way that Nick and his group are doing it with the first and the second, I think that's really the way to do it, especially right now. That protects everybody involved, and it makes the note buyer feel all warm and fuzzy because then they've got a lot of.
Dave, to your point, if the property's worth 200,000 and your cost basis is when you buy the note after discount is on the first lien, because you really don't. Most people, I shouldn't say all people, don't care who's behind them. Do you agree?
Okay. I
don't care if there's 15 liens behind you.
Okay.
If you're in the position you want to be in, usually the first. So if you're in the first lien position on a $200,000 house, and your cost basis is let's just say 140, okay, and that property goes down 10% in value, and the borrower defaults, I gotta believe at some point in whatever that number is, you feel pretty darn comfortable you're going to get your equity position back as a result of it.
So when you say that, why do we care about equity position? When it goes to foreclosure auction, right, that property is going to either sell third party or default back to us. and we have to sell it. So if that value of property is 200,000, more than likely it's to sell at auction, or when I get back, I could probably sell it for 140 and get my money, my balance out.
You do it. We do know this for a fact. You have a lot better getting your money back if you're only in it for 140 than if you're in at 160 or 170 or 180. Would you agree on that? Right.
Yep.
So
If
that's
my
all we're
balance-
trying to do is mitigating our
We'll
risk.
never buy a loan over what the UPB is for multiple reasons. If they pay off tomorrow, I don't get my money back, right? I can only get up to what they call legal balance, which includes tax insurance. We talked about it in our building confidence course, but you get all that kind of stuff. But you need to be calculating if you're buying these notes. I don't care how long it's performing, you've got to calculate the fact that if it defaults, because things do. And it could be no control of the originator. It could be no fault at all. Both parents die and the kids have the house and they can't do anything with it. Like, what do they do? Right? Things happen and it's out of our control sometimes.
And they happen more often than you would think. I mean,
Yeah.
Dave and I grew up on that, like you said.
Look,
and
it's
we've
a
seen
30
all
year, it's
kinds
up
of
to a
situations.
30-year mortgage, right?
Yeah.
Life happens in a 30 years.
Yeah.
Something happens.
I
and
lost
then
my
has to
hand
be
30
addressed.
years, you know?
Yeah.
So,
Nice.
you know, I think 80-20 rule, if you guys are doing it, it's great. And if you can sell those notes to us, we can give you that money. You can go buy another note or buy more, right? We talked to someone recently who said, listen, every $10,000, I can go get a subject-to property and get into it for 10 grand that has $100,000 in equity. Can you keep funding me? And the answer is yes. All day long, as long as my yield number equals, I can buy as many as you want to sell me at a good number.